Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, I have a very special guest, and I know I say that from time to time, but I really mean it this time. His name is Gino Barbaro. Gino is an investor. He's a father of 6. He's an author. He's a coach. He's a teacher. And Gino is actually one of my first mentors when I got into real estate. And so very excited to have him on the show today and share his wealth of knowledge. So how you doing, Gino?
Kent, I'm doing phenomenal. And, we got the chance to speak earlier on this week and to, I guess, put a bookend to that introduction that you made to me. You're the reason that led me down the rabbit hole of money coaching. I just want to let you know that you are one of the reasons why.
Well, I love that. I love that. And so it's a great evolution for you. And I guess the part I skipped is, how does this relate to multifamily, right? Well, because Gino owns about 400 million in assets or so at this point. So, he's done a good job acquiring a nice portfolio as well.
And the reason why I said that, I should just really end with the story on that. The reason why the money coaching, when you joined Jake and Gino, you were a sales guy. You had no experience. You didn't have a ton of capital, but you had something about you that you wanted to really excel at this business. And you came to the events, you put in the work, you put in the time. And I always was wondering why someone like Kent, who really shouldn't, no offense, you were like me. You had no experience. You didn't know what the heck you were doing. But within 6 years, you have this massive amount of achievements, massive amount of accomplishments. And then you have someone else who has more money than Kent or Gino, who's probably better looking than Gino. I don't know about Kent, but has all of the skills, and they don't achieve success. And that really always just baffled me. I didn't understand why. And it led me to money coaching. It led me to a person's relationship with money. And it led me to our patterns, our behaviors, our beliefs. It led me to the fact that Kent didn't want to be on an airplane 50 weeks of the year, that his wife's giving birth and he's back on the plane. All of these things came into convergence. And the reason why I'm mentioning all this is you're listening to the podcast right now. You can go out and you can do a deal and you may make money or you may not make money, but you need to be in it for the right reasons. You need to really learn. And I like how you said passive investing for the professional. Just because you're putting money into a deal passively doesn't mean that you should shirk the responsibilities of the deal itself, of how to manage and run the business. I'm going to give Kent my money because I like Kent, but that's not the only reason why I'm giving Kent my money. I need to understand the vehicle that Kent is driving. If I can't conceptually understand it or know how to underwrite the deal or understand the exit or understand what an IRR is or understand the business plan or understand my alignment of interests or not aligned with his. If I don't know any of that stuff, please don't invest passively. Spend the time to educate yourself and to understand what your relationship with money is. Because what you're trying to do with real estate, especially from the passive side, you're trying to build a portfolio slowly, diligently, wisely, so that at the end of 5 or 6 or 10 years, these assets start paying you off. Equity starts matriculating in large chunks and you're able to place more of that equity. But you need to start with a firm foundation. You need to understand the business as if you are going to be doing this business actively. And if you can take it from that mindset and the other mindset that real estate is a business, it's buy right, finance right, and manage right. You need someone like Kent managing the assets for you, because that's where you make money, in the operations of the business. Now, you're investing passively. You may not know how to understand how to manage that deal, but you should have at least a base foundation of what asset management looks like. So when Kent sends over a T12 or he sends over a draw report, you can at least understand it, decipher it, and say, hey, this doesn't make sense to me. I don't understand this. Why are we losing money? Or, hey, great job. So when you're looking at investing passively, understand your relationship with money, understand your goals, understand that it's a business, and then understand what you're trying to accomplish with that investment.
Yeah. I mean, there's a lot of good things you said there, Gino. And I think that's a really great direction to go with our conversation because, we spend a lot of time on the show talking with experts and talking about deals and what to look for in a deal. And as a passive investor, how do you vet deals? But I love what you started with was this relationship with money, and this whole idea of why are you doing it in the first place? Do you even understand your goals? Do your decisions align with your goals? And I know one great thing about you is you have a framework for everything as a coach to kind of break things down and help make it easy for people to understand, right? And so I know you've got a framework for passive investing. As we go through that today, I want you to also think about layering in this idea of people's relationship with money and why they're doing what they're doing. And that idea that you said, right, which is very true. It's like, as a passive investor, the active part is all before you make the investment, right? Then it goes a little more passive, but there's a lot of work that goes up in making sure you're making the right investment with the right person, right? So, so let's kind of unpack this framework with that lens of like some of this new stuff that you've brought to the table as well.
Well, I created the framework because I started out investing in real estate. My first deal was a triplex. And then I got too busy when I was at the restaurant. So I'm like, hey, listen, I've got 172 grand in the bank. I need to place that money, right? And I always, from that experience, I really learned the person with money meets a person with experience. The person with the experience gets the money, and the person with the money gets the experience. And that was me. And I had to realize it wasn't the deal. It wasn't the sponsor. A lot of the blame fell upon me. In 2005, I'm sitting at the restaurant in the parking lot. In drives a guy driving a gold Maserati. I started calling him Maserati Mike. Maserati Mike had a deal. I'm like, okay, I've got money in the bank. Mike, let's invest in your deal. I didn't do any due diligence. I didn't know what a mobile home park was. I didn't even know what the hell underwriting or T12s were or cap rates or cash on cash. I just said, Mike, here's some money. Let's put money into the deal. Hey, everything worked out great for 6 months. About 6 months later, checks stopped coming in. 6 months after that, Mike is not picking up the phone. 6 months after that, the deal is gone. The mobile home parks are up in dust. And from what I know, went to foreclosure. He lost those and he lost the other X amount of mobile home parks that he had been investing in, that he owned. He was partial owners. Now, it really threw me back for a loop, Kent. It was around the Great Recession, around 2007, 2008. I could have really helped me having 172 grand in the bank. But what it taught me more than anything was, wow, I just gave my money to somebody. I didn't understand the business. I didn't have my interest aligned with his. Did Maserati Mike have any money in that deal? No. He just walked away. He had nothing to lose. Did Maserati Mike create a syndication? Because it's basically, I was being a passive investor. Yes. Did I get any syndication docs? No. So I can sit there, blame Maserati Mike, as a lot of LPs can blame GPs today. And I'm sure there's a lot of cause for that. But as that limited partner, I needed to look in the mirror and say, was it Mike's fault? Yes. But was it my fault as well? Yes. And the great thing about it was a huge problem. The opportunity was, okay, I still need to figure out this real estate thing because this restaurant thing ain't going well anymore. There's so much competition. There's Grubhub. There's Uber. People don't want to wait 20 minutes to eat anymore. So I just fell upon multifamily. I went out. I joined a couple of mentorship programs, really learned, met my business partner, Jake. We started buying deals together and, one thing led to another. We syndicated a few deals. But as the market cycle changed, everyone was talking about syndications. And Ken, that's why it dawned upon me, this framework, this model, I wish I had it when I was investing as a passive investor. And if you don't mind, let me just go through it really quick and then you can diagnose each part and ask me questions about each part. I think it's real simple. First of all, if you guys want to learn more, you can go to wheelbarrowprofits.com. There's a community there. It's an amazing multifamily community. Go check them out. They have the framework even more blown out. But it's really simple. The 3 steps. The first step is the sponsor, or what I like to call the jockey. Think of a jockey who rides a horse. The second part is the saddle itself, which is what we call the alignment of interests. And the third part is the horse, which is the deal, which is the buy right, the manage right, and the finance right. Now, most beginning investors and even more experienced investors and passive investors, what do? What's the first thing in their mind? Well, I've got 172 grand in the bank. Where am I going to find a deal where I'm going to make a return? We all do it in our very first few deals. And that's what you should be doing in reverse. Don't even worry about the deal. I should not have worried about the mobile home park or the self-storage or the multifamily. I should have focused first on the sponsor, on the jockey himself. And I focused on the opposite. And when I picked Maserati Mike, he was the wrong sponsor for a multitude of reasons. His business plan was terrible. His communication style was terrible. He hadn't been doing it for very long. If I had just gotten onto an airplane and flown down and spent $1,000 for the airplane ride and for the hotel room, I would not have invested in that mobile home park. I just wouldn't. So if you're going to go out and you're going to stroke a check to somebody and it's your first investment, maybe get in a plane. Go fly out to the property, maybe go onto the property, maybe secret shop the property management company that you're going to be going into business with. Because once again, you're putting your money into passively, but you're investing in that business. Now, that's the sponsor, Ken. And I think just out of, if I had just done that, I would have passed on that. I may not have met Jake because I may have done other deals, but from your perspective, don't you think everybody investing passively, that's the first place they should look?
Absolutely, Gino. Absolutely. And I mean, short story, I know I've shared it with others. I had a similar experience, right? Mine was through crowdfunding, but one of my first investments, you're scrolling through a website, right? And that deal looks good. Boom, click, send your money. Same thing, no due diligence, nothing. And ended up losing all the money in that deal, because of a bad sponsor. And so I completely agree that, yeah, you're really investing. I mean, the deal could be the best deal in the world, but if the person doesn't know what they're doing and they don't have integrity, right? They're not credible. They don't have the cash to support the deal. If things go sideways, then I think, yeah, you're right. You're really taking a big risk. So I completely agree. You start with the sponsor. You understand that. And I like what you said too. Like I think people often think of, oh man, $1,000 like that. That's a lot of money. I don't want to take the time to do the flight but like if you're investing $100,000, like $1,000 to protect that 100,000, I mean, it seems like a good additional investment, right?
Yes.
I mean, because I've done the same thing and I've had examples where I have done the flight and gone down and met with people and, sometimes, yeah, you get a good feeling. Sometimes you don't, and I'm always happy for those investments I didn't make. Yes. Because, of that gut feeling or you're seeing something or something seems off. And so, yeah, I completely agree that those are some great tips for folks.
Kent, it's also, if I had $1 for everybody who joined our community and said, if I had joined you before I made that LP investment, I never would have made the investment. It's really learning the business. So you can blame the sponsor all you want, but if you understand the business, you wouldn't invest with that sponsor. And when I talk about the sponsorship team and I talk about the sponsor, I'm not only talking about the sponsor, I'm talking about everybody on that sponsorship team. There may be 4, 5, 6, 7 people, but let's extrapolate that even farther. That sponsorship team has to have a good CPA. They need to have a good syndication attorney. They need to have a really good cost segregation specialist. They need to have somebody who's property managing the property, who's asset managing the property, who's doing investor relations. Go out. You can use chat, Google, whatever, and just type in team members. You have to have a really strong list of team members. And I would find out every single team member that they have. And you'll see if they're working with professionals in the industry, you'll find out if they have a strong team. Now, once you've solidified that, you like Kent. You like his business plan. He's been doing it for a while. He's increased NOI. He's just not making money on cap rate compression, but he's really doing his value add, right? He's been in the business long enough. He's gone through a couple full cycle deals. You like the communications. He's got webinars every month. He gets back to his investors. You like the value that he's providing to the investors. The second part is that saddle. It's the alignment of interests. And that's pretty important because I may like Kent, but Kent's model may not be for me. Let's say Kent likes to get money and turns it in 2 to 3 years. I'm like, I want cash flow. I want passive income. I don't want capital events where I'm going to be constantly getting nailed with capital gains taxes. That may not be a good alignment of interests, right? Even though Kent may be great. Or I may be the kind of investor that's like, you know what? I want Kent to have a little more skin in the game. Kent's only got 5% of his money in the game. I may want something more. Now, that's all up to the individual investor. I'm not trying to give any kind of criteria, but I would like to see a sponsor have some type of skin in the game on top of them signing the docs. So if something goes wrong, that's what sponsorship teams do. That's an alignment of interest. They're guaranteeing the debt, right? That's the great thing. It's non-recourse, but they're sponsoring the debt. So you got to make sure that your interests are totally aligned with the deal itself. And if they are, and if you like the business plan, you like the alignment of interest, everything checks out, then the third part is, okay, let's look at the deal itself. The horse, the buy right, the manage right, the finance right. Then you start the underwriting. Don't waste time underwriting a deal, looking at markets if you haven't found the sponsor and that sponsor doesn't align with what you're trying to accomplish.
Mm-hmm. Yeah. So your recommendation, because I love how you step through that, is don't worry about finding the market you want to invest in. Find the sponsor you want to invest with.
Yes.
And then make sure that they're aligned, in the markets and things, but find the sponsor first.
That's a great point. So it's also very interesting. If you find the sponsor, but he's not in the market so there may be some markets that you don't want to as a passive investor. This may be more high level. If you're a passive investor and you're living in a market that you don't like, but you find the sponsor there, you may be like, I don't want to invest in that market. Then don't invest in that market. Don't invest in that sponsor, right? But if you're in Dallas, Texas market, you're like, I love this market. I love the growth. I love the jobs coming in. I love the way they're expanding, the path to progress. I love all of that. Find sponsors in that market. And that's the great thing about being a passive investor. You can actually go out, and when people say diversify their risk, you can diversify your risk over different markets, over different asset classes. You can invest in multifamily. You can invest in self-storage. You can invest in data storage. You can invest in different vintages, ages. You can invest in different property types. So the great thing about it is if you could pick the right sponsor, ATM machines, whatever it is, if you like the sponsor, then you can diversify into different markets, different sponsors, different assets. That's the cool thing. But you still have to understand that those interests need to align with you. And then you need to understand that buy right, manage right, finance right framework to be able to invest. Because when you're buying, even a business, you're buying a business and that sponsor is going to run that business. They still have to buy it properly, finance it properly, and then they have to have the systems or the operations to be able to manage that business as well.
Yeah. I mean, I think that's a great framework. Good expansion on what I learned from you back in the day, the buy right, finance right, manage right, and then taking that to the passive investor. I'm curious in that framework. I know you've taught, I don't know how many people over the years, a lot, probably thousands at this point, right? You've taught these frameworks. What are some of the things that people get wrong?
I think the biggest thing in real estate, Ken, you're probably experiencing this too. Sometimes we just get bored. There's not a lot of activity and we fall off and we create these goals and say, we're going to buy 100 units by the end of the year. And we get so attached to that goal. The goal is just the result. James Clear says it best in his book, Atomic Habits. He says, don't fall in love with the goal, fall in love with the system or the process that's going to get you to that goal. And that's one of the biggest mistakes that I see investors make. A couple more. The second one is they don't have a map or a framework. I always like to joke around life before Jake and life after Jake. Life before Jake, I had no map. I had no buy right, manage right, finance right. All I had was let's buy a good deal. And as you can see my progression, I went from a fourplex to this mobile home park, to a strip mall, to a mixed use commercial. You could see there was all just trying to hunt for deals. There was no framework. There was no process, no business plan whatsoever. That's the second thing I think investors make mistakes on. And I think the third thing, there's so many, but the third one is not understanding the exit strategy. People sometimes just say to themselves, I'm going to buy a deal and hold it forever. It may work in residential, but commercial, you do have debt coming due. You do have different market cycles where it does make sense at times when the market is peaked and you have a syndication that you need to return your capital. So understanding what that exit strategy looks like and planning for it, that's something that I did wrong. I never did that on my assets and it came back to haunt me. So understanding those three things, if you can stay away from those or at least plan for those, it'll help you out with your investments.
Yeah, I think those are great tips. And I think that also relates to what else you were talking about around people's relationship with money or their goals or their understanding their alignment. So, I mean, part of it was when you were buying all these different things, right? You probably weren't really clear on exactly what you wanted, right? And you didn't have the process then to get there. So talk about that as, okay, so somebody, now they understand your process. They understand the jockey, the saddle, the horse, and all of that. But how do they know which, what's the analogy there? Which race they should even be running in, right? What should they be choosing? And how can people help get there? Like, so should they be going for a 2-year hold or a 5-year hold? Do they want cash flow? Do they want appreciation? Well, they probably think they want both, right? But those kind of come inverse of each other, right? Like you don't obviously get both usually at the same time. So how do you help people get clear on what their goals are so they can start to now say, now I can find a jockey that aligns with the goal of what I'm trying to go after?
Zig Ziglar says it best. If you aim at nothing, you're going to hit it every single time. Mm-hmm. And I am a proponent of that. I've done that in my past. Everyone would always ask me, Gino, what do you want to do? And I would always say, I don't want to be at the restaurant anymore. Well, what am I aiming at? Not the restaurant. Well, I mean, that's not really a target. Yeah. So I think to answer that question specifically, I would just say, why are you investing in real estate? I mean, bringing it back to me, I just wanted initially just to create some kind of passive income in the beginning. I had the restaurant. I never thought in my wildest dream I could leave that business. So I'm like, okay, let me buy multifamily so I can create some income on the side. I had 4 kids at the time. So I'm like, let me do that. I got clear on that. But as I had a little bit of success from that, I said, well, my goals are going to start changing. I want to get out of this business and go into this real estate thing full time. So all of a sudden, different mindset, different goal, different target. If you're listening to this, the first thing you need to do is, what do you want to accomplish with real estate? If you're a high performing attorney, doctor, salesperson, IT, engineer, and you're doing really good at your job, maybe it may be difficult to go into this business full time. Maybe focusing on it passively and saying, hey, I just want to get my money from my 401k, put it into real estate long term. I want to get some benefits from that. I may get some passive losses from this, but I may own some businesses that have passive income coming in. I can wipe off the losses and the income from the passive activities. That may be a strategy. Or you may be saying to yourself, I've got a ton of capital. I want to get into this business full time. I would still do some passive deals because you can learn while you earn. And then all of a sudden you start working with that sponsor. You may be able to align yourself with that sponsor and start working and doing deals with that sponsor. So Ken, it really comes down to what kind of race do you want to run? You want to run a race where you're trying to plan for retirement? You want to run a race where you just want to put some additional assets into a different asset class? You may be stock heavy and say, hey, you know what? I've got a couple $100,000. Let me put it into this real estate thing. Well, that may be only 2 or 3 investments in real estate. Or, hey, you know what? I have a burning desire to do this thing full time. Well, you can see the different kind of races you're running. But going back to that framework of the horse and going back to the buy right, manage right, finance right, that's applicable in any race that you're trying to run.
Yeah, a couple of things that you really said there sparked something for me. It's like I have a lot of conversations with people that are on the fence of active or passive in real estate, right? And they're like, oh, I think I might go buy a duplex, or I might go buy a quad. And it is always those high performing professionals, right?
Yes.
And I think what I know, because I know how hard this business is, I know that if you don't love it, you are not going to succeed. Like I am absolutely obsessed with real estate. I like it. I love it. I live it. I breathe it every day. I even do a podcast about it, right? Like I like it that much. It's like, if you don't like it that much, like you should not be owning your own real estate. And it's like, so there's that aspect of it, but it's also like, if your goal is just to create some passive income, the headache of owning your own real estate to just create some passive income, like they are not aligned, because there's a lot of ways to create income without buying your own properties, right?
Yes.
Case in point, I mean, one is invest with me, but I mean, there's thousands of other ways to do that, right? So I think it's so important understanding your goals, understanding why you're doing what you're doing so that you can, not get into something that ends up being more of a headache than it's worth, right? At the end of the day, I think is super important as well.
I would say if you're a doctor and you're working 60 hours a week and you're saying to yourself, I may want to buy a duplex or a triplex. If you don't have a spouse that can help you out, if you don't have a child that you can help you out, it's going to be very difficult initially to be able to manage that triplex because you don't get many phone calls. But when you're in surgery at 12 o'clock on a Friday night, that hot water heater is going to go. And that's when the phone call is coming. How do I know? Or the heat goes out on Christmas Eve. And it's just the reality of the situation. And I think if you've got a really great job, you're making great money, I really would start passively, start finding to put a couple investments. You don't have to go all in on one investment. Maybe put 50 grand in one, 50 grand in another. Like I said, diversify, see how they work, let them work a little bit. And then after a while, you're figuring it out. You may say to yourself a year down the road, hey, it's my turn. I want to start joining a team and I can start helping that team in certain areas. To me, that would be the natural progression for somebody who's got a high paying job or who just doesn't have the time, is busy with their family, has other investments, has other things going on. It's a great way to get started.
Yeah, I agree. And I mean, that's really aligns with my own story too. Like that was really even as I was meeting you and getting more interested in the active side, right? I had been investing passively for years before that. With other sponsor groups, with groups, local here in Indy and then other groups I started meeting. So I had invested a lot passively. And to me, that is absolutely a great way to kind of get behind the curtain, understand what's going on, figure out if you like it or not. If you're thinking about potentially going active. And so that was a great path for me too. So I'm glad you mentioned that. And I'm glad we got to bring that up because it is a great way to just really understand how all of this works, right? Because it is a complicated process.
Yes.
Owning real estate, raising money, all the things that we do, it's all complicated. It's not rocket science. Anybody can figure it out. But like I said, you got to love it, right? Like you got to love it.
Yes.
Absolutely, Gino. Well, man, thank you so much. This has been just fantastic education. And I love your framework. Obviously you got to buy it right. You got to finance it right. You got to manage it right. But again, like we said, if you're not in love with that and you want somebody else to do it, then find the jockey, make sure he's on the right saddle and, the rest is history. I mean, it should all work out. You guys will all be aligned. And so I love the framework for people to grab onto. Before I let you go, Gino, I want to take you through our keys to success round. And there's 4 quick questions I want to ask you. No brain teasers. Don't worry. The first one is, and this is perfect for our conversation. If you were a passive investor and you were going to place money with a sponsor, right? It's not Maserati Mike, somebody else. And you can only ask them one question. Like you don't know anything about the deal. What's the one question you're going to ask that sponsor?
Have you lost money?
Yeah, that's a good question.
And how much? And what did you do when you lost the money?
Yeah. What are you looking for with that question?
It's interesting. If you've been in real estate long enough, you're going to lose money. And what I'd like to hear the person say is, like myself, I've lost a lot of money, but I've lost my own money. And what I would like to hear is, hey, you know what? We lost money. Market went down. Our debt came, whatever. I'd like to hear the reason why and how they overcame that. And what do they do to their investors? Did they make their investors whole or what did that look like? And I want to hear a really honest answer. And if they say, well, they've never lost money, I'm going to say to them, how long have you been in business? Because we all tend to lose money in this business one way. I joke around to you and I've joked around to a lot of people. Jake, my business partner, is lucky. He has not lost money in a real estate deal yet. It's because I lost all the money before I met him. So when we got together, it was all about buying really good quality deals. It's no deal is better than a bad deal. That's our mantra. And I just think that, I can go on stories about losing money in real estate. And I think that's the question I would ask.
And you're right. Whether it was, me trying to flip houses or it was like a lot of lessons learned there it is going to happen over a long enough period of time. Yeah. Right.
Yes.
But I love, how did you respond? How did you treat your investors? Right. Mm-hmm. And you're looking for that honesty too, to be able to admit that, here's what went wrong and here's how we dealt with it. Mm-hmm. You pay for that. It's a quote, right? You're going to pay for your education one way or the other. Right. And that's just paying for that education. So by the time, Jake came in, and he's just been living the easy life because of all the hard knocks from Gino. So
yeah, I wouldn't say easy life, but you know what I mean? It's one of those things where I had enough pain. Smart people learn from their own mistakes. Wise people learn from others' mistakes. And I think Jake's got a lot of wisdom where he knew, because we have a business partner named Mike who's very astute. very smart business guy. So he sort of mentored us as well. So we were never the kind of guys that were like, hey, we know what we're doing. We always were open to mentorships, and we were always open just to buying good deals. We weren't focused on, fees. We were just focused on buying quality deals at a good cost basis that we knew we could add value and that we knew we could hold these things for the long term. That was our focus.
Yep. Perfect. Next question. What are you most proud of in your career?
I think one of the things that really stands out is that I was able to leave the restaurant when I was 46 years old. I had been doing it for over 20 years. And people say, old dogs can't learn new tricks. Well, this old dog learned how to, get into another business and actually exit the old business and go into the new business. And, one restaurant, 20 something years, I have 500 units within 5 years. I mean, that is, to me, it's a great feeling, because just knowing that I was able to leave, something that I had done for over 20 years and be able to go into another business, that was really, really cool, really big highlight in my life.
That is cool. And, they say you can teach old dog. Look at this. You just have to have enough drive, right?
Yes.
You got to understand your why and have enough drive to get there. Love that. What is a book that everybody should read?
Oh, wow. There's so many books. If I had to have one pop in my mind, I would say Mindset by Carol Dweck, because that really, that's when the old dog can learn new tricks. I mean, like if your mindset is there and you have a growth mindset, you can learn it. But if you have the fixed mindset, you're not going to learn new tricks. You're going to be the one trick pony, and you're going to be stuck in that mindset of like, it's everyone else's fault. I can't learn anything. The market's always down. Woe is me. You get fed up after a while in life. And if you can adopt that growth mindset, and she spells it out pretty simply in the book. Phenomenal book.
Yeah, man. I just feel like that's so key to almost every part of life, right? Just having that growth mindset. Yeah, absolutely. Last question, Gino. What is your number one key to success?
This may sound, I don't know, is the word pedantic, or it doesn't seem like that big of a deal. But when I have to get something done, I just don't make any excuses and I get it done. It could be just calling somebody, following up on an email, creating a PowerPoint presentation, getting on a level 10 call, scheduling this podcast and being prepared for it. I think if you're the type of person that gets things done, and I don't want to confuse activity with like progress, right? But ultimately, if you become an active person and you become disciplined and you start getting things done, you'll eventually start getting the right things done, right? And in real estate, there's two things that you need to get done in real estate. You need to source deals and you need to source capital. And if your activity is such that you start sourcing more deals, you start sourcing more capital, I think if you can have that kind of skill set or that kind of habit where, hey, you know what? I need to do this today. Let me see what needs to get done. And you don't waste the time. You put your focus and effort on achieving those goals. I think it'll make you it made me much more, what's the word? It made me so much more valuable to our partnership with Jake.
Mm-hmm. Yeah. I love that. I love the idea of not confusing just being busy with adding value or like being productive. Right. I mean, there's so many of us get caught in, you just answer emails all day. Well, what'd you really get done? Not a lot. Right. So getting the right things done is what's important. Right.
Mm-hmm. Yes.
Well, thank you, Gino, so much for coming on the show. If folks want to get in touch with you and learn more about what you're doing now, how can folks reach you?
Just subscribe to the Jake and Gino podcast. And if you'd like to find out more about the family company that we have, just go to Barbaro, that's Barbaro 360.com and learn more about our family company.
Perfect. We'll make sure it's all linked below so everybody can access and get in contact with Gino. And with that, Gino, I hope you have a great rest of the day.
Thanks, brother. Have a good weekend.
Appreciate you, man.